Do you know the key financial metrics every entrepreneur should know in 2024? Let's dive into the world of finance, where numbers tell stories and can often predict the future of a business. Financial metrics, also known as business or financial performance indicators, are the compass guiding entrepreneurs through the treacherous waters of the business world. These figures provide an overview of the company's health, revealing strengths, weaknesses, and areas for improvement. They are like the pulse of a business, indicating whether it's thriving, merely surviving, or gasping for breath. The importance of understanding and tracking these metrics cannot be overstated. They are the DNA of your business, the key to understanding what's working and what isn't. They help to make informed decisions, attract investors, and drive sustainable growth. Without them, you're essentially flying blind. And that's a risk no entrepreneur should take. But here's the sobering truth. Poor financial management is a primary cause of business failure. It's a silent killer that has led to the downfall of many promising startups. In fact, over 45% of small businesses fail within 5 years, and lack of understanding and application of key financial metrics is often the culprit. But worry not. This isn't a doom and gloom story, far from it. This is your opportunity to learn, to grow, and to arm yourself with the knowledge you need to succeed. After all, knowledge is power, and in the business world, financial knowledge can be the superpower that sets you apart from the rest. So, are you ready to take control of your business's financial health, to understand the significance of revenue, profitability, growth, cash flow, liquidity, and efficiency metrics? To learn how to track and analyze these vital signs of your business, stay tuned as we delve into the essential financial metrics that can make or break your business. Let's start with revenue, the heartbeat of your business. Just as your heart pumps blood through your body, revenue is the source of vitality for your business, keeping it alive and thriving. But what exactly is revenue? Simply put, revenue is the total amount of money your business earns from its operations before any expenses are subtracted. It's the top line on your income statement and the starting point for calculating profit. Now, not all revenue is created equal. There are different types, and understanding these can help you make more informed decisions about your business strategy. First, there's recurring revenue. This is the income that you can reliably expect to receive on a regular basis. Think of a subscription service or a monthly retainer. This type of revenue is predictable and provides a steady cash flow, which is particularly valuable for planning and forecasting. Then there's non-recurring revenue. This is income that you receive irregularly or as a one-off. An example could be a large contract or a significant sale. While it can provide a nice boost, it's less reliable for planning purposes since you can't be certain when or if it will happen again. Why is it so important to track revenue? Well, it's a direct reflection of your business activities. A steady or growing revenue stream indicates that your business is healthy and that customers value what you're offering. On the other hand, a decline in revenue might signal a problem that needs addressing. Moreover, potential investors or lenders will often look at your revenue to gauge the health and potential of your business. In the end, revenue is more than just a number. It's a vital sign of your business, a measure of its performance, and a key driver of its success. So keep a close eye on it, understand where it's coming from and how it's changing. Use it to steer your business strategy and fuel your growth. Remember, revenue is the lifeblood of your business, and tracking it is key to your success. Profitability, it's more than just revenue. It's a mantra that every entrepreneur should take to heart. Why? Because profitability is the ultimate measure of a company's financial health, the true barometer of its long-term viability. Let's break it down. You see, revenue is the total amount of money your business brings in. It's a crucial indicator, sure, but it's just the tip of the iceberg. On its own, revenue doesn't tell you how much of that money is actually contributing to your bottom line. That's where profitability comes in. Profitability is what's left over after you subtract your business expenses from your revenue. It's the real meat and potatoes of your financials, the dollars and cents that you can reinvest in your business or pocket as earnings. There are two types of profit you need to keep an eye on: gross profit and net profit. Gross profit is your revenue minus the cost of goods sold. It shows how efficiently your business is producing and selling its goods or services. Net profit, on the other hand, is what's left after all your business expenses have been paid. It's the ultimate measure of your business's financial performance, but here's the kicker. A business can have high revenue, but low profitability. Imagine a company raking in millions in sales, but spending just as much to keep the operation running. It's like running on a treadmill. Lots of movement, but going nowhere. That's why profitability is so crucial. It's the difference between a thriving business and one that's merely surviving. Understanding profitability can also help you make smarter business decisions. It can guide you in setting the right prices for your products, identifying cost-saving opportunities, and determining where to invest for growth. It's the compass that points the way to sustainable success. So remember, while revenue is important, it's not the be-all and end-all. Dig deeper. Look at profitability. Because at the end of the day, profitability isn't just about making money. It's about making smart business decisions. Next up, growth metrics, the future of your business. Growth metrics are the crystal ball of the entrepreneurial world, offering a glimpse of what lies ahead. They are the compass that guides your journey, helping you navigate the rough seas of business. So what exactly are these growth metrics? Let's start with a couple of key players: customer acquisition and customer retention. Customer acquisition is all about how many new customers you're attracting, while customer retention focuses on keeping those customers coming back for more. Both are equally important and intertwined. To grow, you need to both attract new customers and keep them loyal to your business. Think of it like a garden. Customer acquisition is planting new seeds, while customer retention is nurturing those plants so they continue to bloom year after year. If you're only planting new seeds but forgetting to water them, your garden won't thrive. Similarly, if you're only watering old plants but not planting new seeds, your garden won't expand. Now, you might be wondering, why are these metrics so vital for long-term sustainability? Well, tracking your growth metrics helps you identify trends and patterns in your business. These trends can reveal whether your marketing strategies are working, if your product or service is resonating with your audience, or if there's room for improvement. For instance, a steady increase in customer acquisition could point to successful marketing campaigns. On the flip side, a decline in customer retention may indicate that your products or services aren't meeting customer expectations. By identifying these trends early on, you can pivot and make the necessary adjustments to ensure your business continues to grow and thrive. Growth metrics also play a crucial role in attracting investors. Investors want to see that your business has the potential for growth. They want to see that you're not only attracting new customers, but also keeping them. By showing that your business is growing, you're more likely to attract investment and secure the funding you need to expand your operations. In conclusion, growth metrics are more than just numbers on a spreadsheet. They're a reflection of your business's health and potential for future success. They're the key to understanding where your business is heading and what steps you need to take to get there. Growth metrics are a window into the future of your business, so don't neglect them. Moving on to cash flow, the lifeblood of your business. Cash flow is the money that moves into and out of your business. It's like the oxygen pumping through your business's veins, keeping it alive, vibrant, and growing. The importance of cash flow cannot be understated. It is the fuel that keeps your business operational. It pays the bills, covers the payroll, and allows for investment in growth opportunities. Without adequate cash flow, your business could be profitable on paper, but still end up gasping for survival. So, what is positive cash flow? Well, when more money is coming into your business than going out, you have positive cash flow. This is the ideal situation. It means you have enough to cover your expenses with a little extra tucked away for unexpected costs or opportunities. On the flip side, negative cash flow indicates that more money is going out of your business than coming in. This could be due to high operational costs, low sales, or poor financial management. A business with negative cash flow is like a car running on empty. It might keep going for a little while, but eventually it's going to break down. The key to managing cash flow is to monitor it closely. Regularly review your income and expenses. Look for ways to increase income, reduce costs, or both. Remember, even a profitable business can fail if it runs out of cash. Cash flow isn't just about survival, though. It's also about growth. With positive cash flow, you can invest in new products, hire more staff, or expand your market reach. It gives you the flexibility to seize opportunities as they arise. In a nutshell, cash flow is the lifeblood of your business. It's the difference between a business that thrives and one that merely survives. Cash flow keeps your business alive and kicking, so keep a close eye on it. Let's discuss liquidity. Can your business stay afloat? Now, imagine your business as a ship. Revenue, profitability, growth, and cash flow are all important to keep it sailing smoothly. But what happens when you hit rough waters? That's where liquidity comes in. In the simplest terms, liquidity is your business's ability to meet its short-term obligations, such as paying off debts and bills without having to sell off assets or borrow more. It's about having enough cash or assets that can be quickly converted into cash. Think of it as the life jackets and lifeboats on your ship. You might not need them on a calm sea, but in a storm, they can be the difference between sinking and staying afloat. There are several ways to measure liquidity, but one of the most popular methods is using liquidity ratios. These ratios give you an understanding of your business's financial health and whether it can handle its short-term debts. The current ratio, for instance, compares your current assets to your current liabilities. A ratio of 1 or more indicates that you have enough assets to cover your short-term liabilities. The quick ratio, also known as the acid test ratio, is a more stringent measure. It excludes inventory from current assets, as selling off inventory might not be a viable option for all businesses. The cash ratio is the strictest measure of liquidity. It only considers cash and cash equivalents against current liabilities. This ratio can give you an idea of how your business would fare if it had to pay off all its short-term liabilities immediately. Remember, these ratios are just tools. They can provide valuable insights, but they're not the be-all and end-all. They should be used in conjunction with other metrics and a thorough understanding of your business's operations. It's also important to note that while having high liquidity is generally good, extremely high liquidity might mean you're not using your resources to their full potential. It's all about finding the right balance. Liquidity is about staying afloat during tough times, so don't overlook it. Last but not least, efficiency metrics. Are you getting the most out of your resources? Welcome to the world of efficiency metrics, the unsung heroes of business management. These are the indicators that help you understand how well you're utilizing your resources. They're like the fuel gauge in your car, giving you a real-time snapshot of how much you're getting out of what you've put in. Let's start with inventory turnover. This little gem shows you how many times a company has sold and replaced its inventory in a given period. It's a fantastic way to gauge the efficiency of your sales process and your inventory management. High inventory turnover can indicate strong sales or ineffective buying, while low turnover might mean weak sales or excess inventory. Like Goldilocks, you're looking for the balance that's just right. Next up, we've got accounts receivable turnover. This measures how effectively a company uses its assets. It's a ratio that shows how many times a business can turn its accounts receivables into cash over a specific period. The higher the turnover, the faster the company collects cash from its customers. But why are these metrics so important? Well, they're like the heartbeat of your business, providing you with vital signs on your company's health. By monitoring these metrics, you're able to identify areas of improvement, maximize your resources, and ultimately increase profitability. Remember, efficiency isn't about doing more with less, but rather doing better with what you have. It's about making every dollar, every resource, and every effort count. So if you're not already tracking these metrics, it's time to start. They can provide invaluable insights into your business operations and help you make informed decisions. Efficiency metrics help you get the most bang for your buck, so make sure to track them. So what's the big deal about these financial metrics? Well, let's take a moment to reflect. We've journeyed through the world of financial metrics, uncovering the heartbeat of your business in revenue, the true meaning of success and profitability, and the promise of tomorrow in growth metrics. We've navigated the lifeblood of cash flow, the buoyancy of liquidity, and the power of efficiency and resource management. Each of these metrics offers a unique perspective, a different lens through which to view your business. They are not just numbers on a spreadsheet, they are the language of your business, telling you its stories of success, struggle, and potential. Understanding revenue allows you to monitor the pulse of your business, ensuring it's healthy and thriving. It's the first step in understanding the financial health of your enterprise. Profitability, on the other hand, is more than just revenue. It's the difference between what comes in and what goes out. It's the measure of your business's ability to generate more than it consumes, a true mark of success. Growth metrics illuminate the path ahead, showing you where your business is heading. It's the compass guiding you towards sustainable expansion and success. Cash flow, the lifeblood of your business, keeps everything running smoothly. It's the oxygen supply to every function of your business. Liquidity, it's the life jacket that keeps your business afloat in the turbulent seas of the market, ensuring you can meet your short-term obligations. And finally, efficiency metrics. They show you how well you're using your resources, how much bang you're getting for your buck. They're the secret to doing more with less, to maximizing your return on investment. So you see, these financial metrics are powerful tools, each providing valuable insights into different aspects of your business. But remember, their true power lies not in the individual metrics themselves, but in their combined understanding. Remember, understanding your financial metrics is understanding your business. So start tracking now.